The second component to the aggregate supply, aggregate demand model, as the title suggests, is the demand side. Aggregate demand is simply the relationship between prices and GDP for any given price level. So what we're thinking of here is household consumption, firm investment, and government expenditure at different levels of prices. And the demand curve is downward sloped. That too is intuitive. The general idea here is that as prices are lower, expenditure is going to be higher. But keep in mind or remember from your principles class that this is not micrologic. In a microeconomic model, quantity demanded falls as the price increases because households have a fixed income. In the aggregate, that's generally not the case. In the aggregate, what tends to be the case is that as prices increase, nominal wages, for instance, over time increase as well. So it's not clear that if the overall price of things is increasing, if there's inflation, that we're actually getting poorer. So don't fall into that trap. Instead, what aggregate demand describes is equilibrium output for any given price level P as described by the ISLM model. Now, unfortunately, we have to get back to the ISLM model for a little bit. It's a bit of a review in case you don't recall. The exam was pretty good, so I assume that most people didn't struggle too much with it. IS relationship is the equilibrium equation in the goods market, and it states that output is equal to consumption plus investment plus government expenditure, still working under a closed economy assumption, still working with the sort of bells and whistles we added to consumption and investment. Notice one thing, that the IS relationship does not contain prices. These are all real quantities, and that comes back to this point I just made. How much we can consume depends on how much is produced. How much firms can invest depends on how much is produced, and so forth. It's not a function of the monetary value of things, it's a function of the physical production level. Where prices do enter, however, is in the LM relationship. Keep in mind that the LM relationship describes equilibrium in money and financial markets, and expressed in real terms as it is here, it states that real money balances need to equal to the real transaction demand, and it will be a negative function of the interest rate, because foregone interest is the opportunity cost of holding money. Now, what happens if prices change for a given level of output? The general idea is that the interest rate will increase as prices increase. And that means the LM curve shifts to the left, and we'll also see that real GDP will decline. Now, this may not be super intuitive, but the actual underlying intuition is very straightforward. If things get more expensive for a given level of money supply, people now need more money. An increase in prices increases nominal money demand. Because there isn't more money, agents will try to sell their bonds. The consequence of that, you have an excess supply of bonds, which reduces bond prices and in turn increases the interest rate. Now, of course, then as you know, as the interest rate increases, investment demand declines, and that pushes down real GDP. Consequence of this, and this is where your aggregate demand curve comes from, is that higher price levels translate into smaller equilibrium output. Graphically, starting with LM0, this LM curve here, at any given level of output, for a given level of prices, you find your equilibrium interest rate. That's nothing new. Now, if prices increase at that same level of output, people will try to get more money by selling bonds. That drives up the price of bonds, and the LM curve shifts up, or it shifts left. This should not be new. Higher prices, higher money demand, higher interest rates. As a consequence of that, as interest rates increase, we move up on the IS curve, and that results in lower equilibrium output. This is our ISLM model. Translating this into aggregate demand, this is a typo, this should be a P. I will fix that in the slides. For higher prices, output will be lower. This is just the standard aggregate demand curve as you know it from principles. The only difference that you know now is that what the aggregate demand curve really is, it is any equilibrium output in the ISLM model for any given price level. Now, the aggregate demand curve can shift. And in principle, everything that is in the IS equation, everything that's in the price equation, everything that's in the LM equation, I should say, that is not the price itself, will shift the aggregate supply, aggregate demand curve. And we'll talk a lot about demand shocks because the typical recession is driven by the demand side. The current one is a little different. We'll come back to that. But in principle, anything that is in the IS equation, anything that's in the LM equation, can shift the aggregate demand curve. Here we'll focus in a very simplified manner on three things. We'll focus on money. Specifically, the money supply M will matter here. Prices will matter a little bit, but we'll come to that at some point. Government expenditure and taxes. And the intuition is the one that you already know from the simple multiplier model and from the ISLM model. An expansionary monetary policy, an increase in M, will increase aggregate demand. It will shift the curve to the right. An increase in government expenditure, fiscal policy, fiscal stimulus, will increase the aggregate demand curve. For any given price level, we're spending more. An increase in taxes, then finally, reduces disposable income, it reduces consumption, and hence shifts the aggregate demand curve to the left. Right? Increase in aggregate demand, shift to the right. Increase in aggregate demand, decrease in aggregate demand, shift to the left. Expansionary policy, increase in money supply, increase in expenditure, cut in taxes. Contractionary policy, increase in taxes, decrease in expenditure. Now, that's all for aggregate demand, really. You know this stuff already. You've seen this one before. You should probably try to play around a little bit with other determinants of aggregate demand. So, for instance, ask yourself the question, what happens if autonomous consumption changes? But for our purposes, we will focus on these few factors predominantly. Next, we'll talk about equilibrium.